What if I told you that tomorrow you could literally just go out and buy $1 million, highly profitable commercial HVAC business,
Okay.
right? And you could retain 100% of the equity, every single bit of it.
Yeah.
Plus, you use government-backed funds to not only pay for the whole acquisition, but also, like, cover the payroll for your new staff.
It sounds completely made up, right?
It really does.
Yeah.
Because, usually when we talk about the government and capital, we picture this massive vacuum cleaner.
Right.
We just expect a huge tax bill, maybe an audit,
Okay.
capital flowing strictly in one direction, which is out of your business and straight into the state treasury.
Exactly.
We are so conditioned to view the state as, like, the ultimate collector.
Oh, absolutely.
But what if we flip that paradigm completely on its head? What if, sitting here in mid-2026, the government is actually functioning as the largest, most aggressive, silent partner in the world?
A partner that wants to fund your business, but crucially, doesn't want any of your equity.
Right. So, okay, let's unpack this, because that paradigm shift is basically the core of what we're going to dive into today for you.
Yeah, the incentive landscape right now in 2026 is, well, it's sprawling.
Yeah.
It is incredibly lucrative. And honestly, it is almost entirely hidden in plain sight.
Which is wild.
It really is. I mean, we're looking at literally billions of dollars formally budgeted just sitting there in federal, state, and municipal accounts. And it's entirely earmarked for entrepreneurs like you.
Just sitting there waiting.
Exactly. The primary friction point isn't a lack of capital. It's really a lack of localized, actionable information.
Founders just don't know the mechanisms, right?
Right. They don't know how to pull that capital down into their own bank accounts.
Which brings us directly to the mission of today's deep dive. We are putting a stack of really heavily researched sources on the table to dissect the actual mechanics of these capital pathways.
And we have some incredible source material today.
We really do. First, we have a super detailed transcript from financial strategist Carlton Dennis.
Right. Who is really well known for breaking down these high-level, hidden 2026 government incentives into, truly actionable tax strategies.
His stuff is great. We also have the latest, and I mean highly granular, North Carolina Small Business Resource and Incentive Guide.
Which is such a good document.
It is. We're going to use that as our sort of real-world test case to map out how state-level mechanics actually function.
Perfect.
And finally, we're analyzing a really fascinating script from it's a borderless digital collective known as the Global Entrepreneur Hub.
Right. So the objective here is highly specific for you, the listener. We want to move past the theoretical stuff.
No fluff today.
Exactly. No fluff. We're going to map the hidden labyrinth of federal, state, and local funding.
Mm-hmm.
And we're going to extract the exact mechanisms you need to find liquidity, completely protect your equity cap table, and, use the structural tax code to aggressively defend the wealth you generate.
I love that. Defend the wealth. So to understand the how, we really have to interrogate the why, don't we?
You do.
Because it feels deeply counterintuitive. Like, why on earth would a massive federal bureaucracy want to act like a VC firm and funnel cash to a local founder?
Well, if we connect this to the bigger picture, we really have to look at the structural history of government economic intervention.
Okay, take us back.
Right. So the architecture of these funding mechanisms traces its roots directly back to the Great Depression in the 1930s.
Right. Dark times.
Very dark. The macroeconomic situation was catastrophic. I mean, the economy was in absolute free fall.
Yeah.
Thousands of businesses were physically collapsing, and local tax bases were just evaporating overnight.
So the government had to step in.
Exactly. They realized that central bank policy, the big macro...
Like interest rates.
Yeah, that just wasn't enough. They had to inject liquidity at the absolute ground level to stabilize the foundational layer of the economy.
The local mom and pop shops.
Right. So they deployed these sweeping programs offering loans, direct grants, and structural assistance to Main Street businesses.
And those localized injections, they basically stopped the cascading failure of the broader economy, didn't they?
They really did.
I think the numbers were they saved something like 100,000 companies just by acting as the lender of last resort.
They did. But, the really critical pivot happened a bit later, after World War II.
Oh, interesting. Why then?
Well, the crisis had passed, obviously, but policymakers started observing the post-war industrial boom.
Everything was scaling up fast.
Exactly. And they identified a new structural threat, which was unchecked monopolization.
Oh, like a few massive companies just eating everything.
Precisely. The theory was that if the state didn't systematically subsidize and support small to medium enterprises, these massive corporate conglomerates would just naturally dominate every single sector.
Just through sheer economies of scale, right?
Right. So the government actually began using small business subsidies as a sort of antitrust weapon.
Wow, I never thought of it like that.
Yeah. By artificially lowering the cost of capital for small companies, they were deliberately engineering market competition.
To prevent that dangerous concentration of corporate power.
Exactly.
But I got to challenge the premise here a bit, though.
Sure.
You're saying the government operates like a venture capitalist, but, a VC writes a check because they want 20% of my company. They
Right.
want this massive exit event where they get a 10x return on their capital.
Standard VC playbook. Yeah.
Right. So if the government isn't taking equity, how does the math actually work for them? I mean, they can't just be operating a giant charity.
No, definitely not a charity. The math works through the economic multiplier effect.
Okay, break that down for me.
The government's return on investment is entirely structural. So let's say the government gives a $50,000 grant to a local manufacturing firm.
Okay, 50 grand, non-dilutive.
Right, to expand its operations. That firm then uses the capital to hire, say, 3 new employees.
Makes sense.
Now, those 3 employees have steady income. What do? They buy houses, which generates property tax.
Ah, right.
They buy groceries and cars, which generates sales tax. Meanwhile, the manufacturing firm itself is increasing its output.
Right, yeah, so their own corporate tax burden goes up.
Exactly. So the velocity of that initial $50,000 just circulates through the local economy.
It expands the overall tax base way beyond the initial grant.
Right. The government's true ROI is simply a stabilized, taxable ecosystem.
That makes total sense, but honestly, I think it highlights a massive psychological block for founders.
Oh, a huge block.
Because when we hear words like funding, runway, or, capital injection, our brains have been trained to immediately picture Silicon Valley.
Yeah, Sand Hill Road.
Exactly. We imagine some 22-year-old in a Patagonia vest pitching an AI startup to a room full of billionaires.
Right.
We definitely don't picture, a local entrepreneur getting a 6-figure government grant to expand a neighborhood logistics firm.
And that specific psychological bias is literally the #1 reason these funds go unclaimed every year.
It's crazy.
Carlton Dennis breaks this down beautifully in his analysis. He points out that founders just assume government money is either, a localized welfare program for the destitute or an elite tax loophole reserved exclusively for massive tech conglomerates.
Right, it's only for the Amazons of the world.
Exactly.
Mm-hmm.
But that 1930s historical context we just talked about proves the exact opposite.
Because these systems were explicitly engineered for Main Street.
Yes. The government does not care if your business model is, quote-unquote, disruptive.
Right.
They only care if your business model is viable, if it'll generate taxable revenue, and if you're going to hire local citizens.
Okay, so if the federal government acts as this overarching macro-level venture capitalist designing the whole system, then the individual state governments must be, the aggressive talent scouts out in the field,
Right.
trying to poach the best investments.
Oh, they are highly aggressive talent scouts.
Yeah.
The source material outlines what is essentially a hyper-competitive interstate bidding war for entrepreneurial talent.
The Carlton Dennis transcript makes this incredibly clear.
It really does.
He notes that nearly every state, regardless of whether it leans politically conservative or liberal, has constructed this massive portfolio of incentives.
Right. It's total bipartisan.
Yeah.
Yeah.
We're talking aggressive tax credits, direct wage reimbursements, and huge state-funded workforce training programs.
Because the calculus for the state economic development agencies is, frankly, ruthless and straightforward.
How so?
Well, companies create jobs. Jobs attract population. Population drives consumption. And consumption is what funds the state's infrastructure.
Oh, I see.
So if a state fails to attract businesses, its tax base shrinks and it literally cannot function.
So they have to compete.
Therefore, states weaponize their tax codes to outbid each other. It's a survival mechanism.
Dennis actually gives some really high-profile examples of this bidding war. He points to the Texas Enterprise Fund, which is notoriously aggressive.
Very aggressive, yeah.
But the names he associates with it are giants, Apple, Toyota.
Right.
These massive companies that negotiate these huge tax breaks in exchange for building 1,000-person facilities in Texas.
Exactly.
But I have to push back here on behalf of you, the listener.
Go for it.
Because this sounds fantastic if I'm, say, negotiating the placement of a $1 billion battery manufacturing plant, right?
Sure.
But what if I am the listener and I'm just trying to launch a 20-person commercial plumbing company?
Right.
Are these state agencies just trading dillions with Fortune 500s and completely ignoring the small cap founders?
That's such a common misconception that incentives only scale to the enterprise level.
It feels true, though.
It does. But to disprove that, we really have to look at the granular mechanics of state-level programs that are actually designed for small caps.
Okay, let's look at the sources.
Let's use North Carolina as our primary case study from the guide. Their official small business resource guide details a program called the NC Edge Customized Training Program.
Okay. NC Edge.
Yeah, and this isn't some tax credit you wait until April to claim.
Okay.
It is a direct operational subsidy. They also deploy what they call on-the-job training grants.
What do those do?
They directly reimburse a percentage of a new hire's wages during their initial training period.
Wait, really? So the state is literally absorbing the cost of a company's learning curve?
Precisely the point.
Mm-hmm.
Think about it. If you're launching that 20-person plumbing company, your highest risk vector is the cost of onboarding and upskilling new plumbers before they're actually fast enough to be profitable out in the field.
Because that lag time just totally drains your cash reserves.
Exactly. North Carolina or Louisiana has a really similar one called the LED Fast Start program.
Oh, right.
They step in and literally pay for that training phase.
Yeah.
They fundamentally de-risk your payroll.
The cash flow implications of having your initial payroll subsidized are just massive. It's huge.
Because then you can preserve your operating capital for, equipment or marketing or whatever.
Exactly.
But the North Carolina guide gets even more granular, which is fascinating.
It really does.
It's not just a flat offer to anyone in the state. They utilize this highly strategic county tier system.
Right, the tiers.
Yeah, they rank every single county from Tier 1, which they define as the most economically distressed, all the way up to Tier 3, which represents the really wealthy, booming metropolitan centers.
And that tier system reveals the actual mechanism of wealth distribution. The state actively scales the financial incentive inversely to the wealth of the location.
Okay, let's run a hypothetical to make this really concrete for the listener.
Let's do it.
Let's say I am that founder opening the plumbing business.
Okay.
If I open my headquarters in a booming Tier 3 city like Raleigh or Charlotte, for example, I might get access to standard state resources, right?
Right, standard stuff. But what happens if I look at a map, drive maybe 40 miles outside the city limits, and lease a warehouse in a rural Tier 1 distressed county?
The math changes exponentially in your favor.
How so?
Well, a Tier 1 county has a depressed property tax base, and it likely has higher unemployment rate.
Yeah.
By placing your facility there, you are essentially solving a localized economic crisis for the state.
Okay, so they reward you for that.
Exactly. Consequently, North Carolina unlocks specialized grants, significantly higher tax credit multipliers, and heavily enhanced wage reimbursements.
Just for being 40 miles down the road.
Yep. They are paying you a premium to act as an economic anchor in a fragile region.
That's brilliant.
And they aren't the only ones. Georgia deploys a nearly identical philosophy with their job tax credit.
Uh-huh.
They heavily weight the financial rewards toward their least developed census tracts. And Ohio uses their Ohio training grants, to aggressively incentivize development in post-industrial zones.
So the state is essentially saying to you, hey, we have a critical infrastructure deficit in this specific zip code, and we are willing to artificially boost your profit margins if you agree to just build your business here and solve it for us.
Exactly. And that strategic alignment, understanding that the state wants to use your business as a localized economic tool.
Right.
That understanding opens the door to the next layer of capital. Because when you realize the state is willing to fund your operational growth, you start looking at the hyper-local liquidity that's available just to get the business off the ground in the first place.
Here is where the source material gets genuinely fascinating to me.
Yeah, the micro levels.
Because reading through the North Carolina guide, the capital structure resembles like a Russian nesting doll.
That's a great way to put it.
You pry open the massive federal funding ball, right? And inside is the state-level capital doll.
Right.
You open that state doll and you find a county-level doll. Inside that is a hyper-local city doll, and each single layer has its own dedicated pool of non-dilutive capital.
The sheer density of these microfunding layers is just staggering when you really look at it.
It really is.
If we focus on the early stage startup runway, the capital is designed to stepladder right alongside your validation process.
Okay, let's check that step ladder. Let's say our hypothetical founder has an idea for a proprietary piece of logistics software, but no actual product yet.
Oh, yeah, just an idea.
Just an idea. The state of North Carolina offers the NC Idea Micro Grant.
Right, the micro.
That is a $10,000 injection specifically designed just to validate the concept and build a minimum viable product.
Right, and the critical mechanism there is validation.
Okay.
Because once you use the micro grant to prove the unit economics actually work,
That the business makes sense.
exactly, you instantly qualify to apply for the NCIDS seed grant.
And that's bigger.
Oh, yeah. That scales the capital injection up to $50,000 to fund commercialization and customer acquisition.
And then you can stack that state capital with regional initiatives too, right?
Absolutely.
Because the guide highlights things like the Small Business Center Network's Startup Showdown, which is a pitch competition offering up to $30,000 in completely unrestricted funds.
Unrestricted is key there.
Yeah. And as we drill down into the municipal layer, the programs get highly targeted.
Super targeted.
Like Raleigh has the Business Investment Grant, which they call the BIG program.
Right.
Alamance County runs launch-scale grants for companies under 2 years old. Winston-Salem deploys the Empowering Growth Small Business Grant. It's everywhere.
It is. But we need to pause here for a second and define the exact nature of this capital.
Okay.
Because all of the programs you just listed provide non-dilutive funding.
Meaning no equity given up.
Exactly. In the private equity world, a $50,000 seed investment forces you to surrender a permanent percentage of your company's future value.
Right. You're married to that VC forever.
Right. But these municipal and state grants cost you zero equity and require zero repayment.
It's just free money.
Basically, they are pure balance sheet injections.
That is incredible. And they even drill down to micro injections too.
They do.
Like the guide outlines these pathway to entrepreneurship mini grants. We are talking about $500 phased disbursements aimed specifically at historically marginalized founders who are completing state training programs.
Right. Smaller amounts, but highly impactful.
Yeah, because $500 might sound like rounding error to a venture capitalist.
Oh, totally.
But to a founder bootstrapping a service business out of their garage, that $500 covers the LLC filing fees, maybe a year of web hosting, and the initial software stack.
It removes the friction.
Exactly. It is the friction remover.
And, the guide also addresses the reality that businesses inevitably face headwinds.
Right. It's not always smooth sailing.
No, never.
Yeah.
When a company needs defensive liquidity rather than offensive growth capital, the ecosystem pivots from these grants to structurally supported loans.
Okay, like,
Well, for example, the Carolina Small Business Development Fund operates specifically to deploy capital to underserved founders who might not meet, like traditional commercial banking metrics.
so when the regular banks say no.
Exactly.
And when a systemic disaster strikes, the federal layer steps back in, right?
Big time.
The sources detail the SBA Economic Injury Disaster Loans, the EIDLs.
Right. We saw a lot of those recently.
Yeah, they were deployed heavily after events like Hurricane Helene, just to prevent mass local bankruptcies.
But honestly, the most structurally fascinating liquidity tool mentioned in the sources is the State Small Business Credit Initiative, or SSBCI.
SSBCI.
Yes, because this program directly addresses the primary reason small businesses are denied commercial loans in the first place, which is a lack of hard collateral.
Okay, let's break down the mechanics of the SSBCI. How does it actually solve a collateral deficit?
All right. Imagine you need a $100,000 loan to buy equipment.
Okay, I need 100 grand.
And the bank approves your cash flow, but they require $80,000 in physical collateral to secure the debt.
Right, they want a guarantee.
But you only have $40,000 worth of assets.
So I'm short 40 grand.
Right. Normally, the bank just denies the loan. End of story.
Yeah.
But under the SSBCI, the government essentially steps in and provides the bank with synthetic collateral.
Synthetic collateral.
Yeah, like a cash deposit or a structural guarantee that bridges that $40,000 gap for you.
Wow.
The bank gets its risk mitigated, and you get the capital you need to scale.
That is a phenomenal piece of financial engineering.
It really is.
But, okay, here is the massive practical hurdle.
I know what you're going to say.
Because the nesting dolls of capital, it's brilliant in theory, right? But how does a founder who is currently working 80 hours a week, running operations, doing sales, managing payroll. How do they actually locate an obscure mid-year USDA rural development grant or an Alamance County micro grant before the application window closes?
It's tough.
These programs are notoriously poorly marketed. Like, they don't run Super Bowl ads for this stuff.
No, they definitely don't. But the North Carolina source material directly solves for that discovery friction.
How so?
The mistake founders make is attempting to brute force Google searches late at night.
Searching free money for business at 2 a.m.
Exactly, which is a terrible idea. The guide actually outlines a centralized hub-and-spoke model for discovery.
Okay.
It explicitly directs founders to the Economic Development Partnership of North Carolina, the EDPNC, and it provides their direct small business advisors hotline.
Oh. So instead of trying to become an expert in municipal bureaucratic architecture yourself, you simply call the architect.
Precisely. You leverage state-funded employees whose sole KPI, their key performance indicator, is successfully connecting local founders with available state capital.
It's literally their job to give you the money.
Yes. Furthermore, the state funds physical small business centers at all 58 community colleges. And if you qualify under a specific designation, such as a historically underutilized business, a hubby, or a disadvantaged business enterprise, a DBE,
Okay.
these centers will actively route you toward capital pools that are legally earmarked specifically for minority, women, or veteran-owned enterprises.
The strategy is entirely about plugging into the centralized nodes of the network rather than hunting for individual grants in the dark.
Exactly.
But, okay, let's take a major strategic pivot here.
Let's do it.
Because even with micro grants and state advisors, building a company from $0 to $1 million in revenue is just a brutal, high-attrition process.
Oh, it's exhausting.
The statistical failure rate for unproven startups is terrifying.
Very high.
So what if you could use government infrastructure to just skip the startup phase entirely?
Now we're getting to the good stuff. This represents one of the most sophisticated wealth generation strategies detailed in our sources, which is acquisition entrepreneurship.
Right.
The model shifts completely from building a business to buying an existing cash-flowing asset.
Carlton Dennis heavily champions this, actually. He cites industry figures like Cody Sanchez and Pace Morby, who have really popularized the concept lately.
Yeah, they talk about this constantly.
And the core thesis is so compelling. Why spend 5 years, thousands of hours, and massive personal capital trying to achieve product market fit
Right.
when you can identify a retiring baby boomer and just buy their established HVAC company?
Yeah.
A company that already possesses a loyal customer base, trained employees, and a decade of profitable tax returns.
The barrier to this strategy has traditionally been the massive upfront capital required to buy a multi-million-dollar business.
Right? Obviously.
Most people don't have $2 million in cash lying around.
Right.
But this is where government-backed financing fundamentally alters the landscape. The government provides the leverage necessary to execute these acquisitions.
We are diving into small business administration loans here, right?
Yeah.
SBA 7A and the SBI 504.
Yes. The critical mechanic to understand here is that the SBA does not lend you capital directly.
Okay, that's an important distinction.
Very important. They act as an insurance policy for traditional commercial lenders.
So if a bank issues you a $2 million loan to buy an HVAC business.
The SBA steps in and guarantees up to 85% of that loan.
Wow, 85%.
Right. So if you default, the government pays the bank. This massive risk reduction compels the bank to offer you highly favorable terms.
Like lower down payments.
Lower down payments, extended repayment schedules terms
Yes.
that they would absolutely never offer on a purely commercial basis.
The sources outline the 3 main vehicles for this. The SBA 7A is the primary engine, right? It's used for acquiring businesses, working capital, buying out partners.
Yep, that's the main one.
The SBA 504 is a different beast, heavily skewed toward acquiring fixed assets like the physical warehouse the HVAC company operates out of, or heavy machinery.
Correct.
And then there are microloans for amounts under $50,000.
But I need to push back vigorously here.
I expect nothing less.
We're casually discussing taking on millions of dollars in debt.
We are. Why use debt at all? If I want to buy a $2 million business, why not just pitch a private equity angel investor, give them 30% of the equity in exchange for the purchase capital, and just operate without the terrifying pressure of a massive monthly loan payment?
It's a fair question.
Because debt feels inherently dangerous, right? What if the economy dips and I breach a loan covenant?
The fear of debt is a totally natural survival instinct,
Hmm.
but we must ruthlessly differentiate between consumer debt and strategic business leverage.
Okay, explain the difference.
Carlton Dennis points out that funding operations on a 25% interest credit card is toxic consumer debt.
Right, that'll kill a business.
Fast. An SBA loan, however, is a wealth-building tool, and it's largely because of the debt service coverage ratio, or DSCR.
Okay, break down the DSCR mechanic for us. How does it actually protect the founder?
When a bank underwrites an SBA loan for an acquisition, they aren't just looking at your personal credit score.
Right,
They are analyzing the historical cash flow of the business you were trying to buy.
the actual asset.
Exactly. They require a DSCR of roughly 1.15 to 1.25.
What does that mean in real dollars?
This means the business must historically generate at least $1.25 in pure profit for every single dollar of debt payment the new SBA loan will require.
Ah, okay.
The bank proves mathematically that the asset you're buying pays for its own debt with a 25% safety margin already built in.
So the asset services its own leverage.
Yes.
And how does that compare to the angel investor scenario I brought up?
Think of it through the lens of a residential mortgage, right?
Right.
But scaled up.
Okay.
If you want to buy a home, you don't give a wealthy friend 30% ownership of your house in perpetuity just so they will buy it for you in cash, right?
Obviously not.
No. You put down 10%, the bank finances the other 90%, and over time, you pay down the debt while capturing 100% of the home's appreciation.
Right. The upside is all yours.
An SBA loan operates the exact same way. You put down 10%, you use the business's own cash flow to service the debt, and most importantly, you retain 100% of the equity upside.
So when you double the revenue of that HVAC business over 5 years,
You capture all of that enterprise value, every penny.
that makes the equity argument pretty undeniable.
I think so.
But let's look at the actual execution. The underwriting process can't be as simple as, like, walking into a Chase branch and asking for $2 million.
Oh, no. It is a grueling, rigorous process of risk verification.
I figured.
The SBA-approved lender demands a very comprehensive data room.
What goes into that?
You must provide a highly structured business plan detailing your transition strategy. You need 3 years of the target company's audited financial statements, 3 years of your personal tax returns, and a very granular use of funds breakdown.
That's a lot of paperwork.
It is. The bank underwrites the viability of the asset, and then the SBA reviews the entire package to authorize the guarantee.
The friction is super high, but I guess the reward is that an entrepreneur can step into the CEO role of a highly profitable, multi-million-dollar enterprise on day one.
Retaining total control of the cap table.
But as you acquire 100% of a highly profitable asset, you immediately triggered the most complex challenge of wealth generation.
The taxes.
The tax burden. When your new HVAC company starts throwing off massive free cash flow, that adversarial relationship with the IRS we discussed at the top of the show,
Yeah.
suddenly that becomes a terrifying reality.
Which brings us to the advanced wealth defense strategies.
Yes.
These are the exact mechanisms high net worth individuals use to legally nullify those liabilities.
Carlton Dennis delivers a really harsh reality check in his transcript for high-income earners, which, by the way, he classifies as operators netting over $750,000 annually.
Right.
He argues that crossing that threshold requires a complete psychological shift from tax compliance to strategic tax reduction.
That shift is everything.
Yeah, because compliance is just making sure your CPA files the historical paperwork correctly so you don't go to jail.
Right. Looking backwards.
But reduction is actively utilizing the tax code to slash your liability by 50 to 100%.
And the foundational misunderstanding here is viewing the tax code as a rule book of penalties.
Right.
It is not a penalty book.
Yeah.
The Internal Revenue Code is primarily a map of behavioral incentives.
A map. I like that.
The federal government uses tax breaks to manipulate capital into sectors where they need development.
So they bribe you to do what they want.
Basically. And if you align your investments with those sectors, the government drastically reduces your tax burden.
Okay.
What's fascinating here is the most asymmetric example of this, which is Section 1202, commonly known as QSBS.
Qualified small business stock. Dennis highlights this, and honestly, the math sounds almost too good to be legal.
It's wild.
Walk us through the exact mechanics of a QSBS exclusion.
Okay, QSBS is basically the holy grail of tax strategy for founders and early-stage investors.
Okay.
Let's return to our hypothetical founder. Instead of buying an HVAC company, let's say she founds a C corporation that develops commercial logistics software.
All right, software startup.
She is issued original stock in the company. The QSBS provision dictates that if she holds that qualifying stock for a minimum of 5 uninterrupted years,
Okay, 5 years.
and the company is engaged in an active trade or business, meaning it's not just a passive holding company for real estate or like a hedge fund.
Right, a real operating business.
Exactly. She triggers a massive exclusion event upon selling the company.
Okay, let's put hard numbers on this so the listener can really grasp it.
Good idea.
She builds the software company for 6 years. A massive enterprise tech firm comes along and acquires her company.
Great exit.
Yeah, and her personal equity payout is $10 million.
Okay.
Normally, she would owe roughly 20% in long-term federal capital gains, right? So she's writing a $2 million check to the IRS.
Right, normally. But under Section 1202, because she met the QSBS criteria, she can exclude up to 100% of those federal capital gains.
Wait, 100%?
Yes. She pays zero federal tax on the $10 million.
Yeah.
Zero. The code actually allows an exclusion of up to $15 million, or 10 times the original cost basis of the stock, whichever is greater.
So she effectively keeps the entire $2 million that would have gone to the IRS.
Exactly.
It operates almost like a tax-free incubation chamber. As long as the business remains in the chamber for 5 years, the harvest is totally protected.
That's a great analogy.
But wait, why on earth isn't every single founder structuring their entity to capture this?
Because the default advice from standard CPAs is to form an LLC for simplicity and pass through taxation.
Oh, because it's easier in year one.
Right. But QSBS strictly requires the entity to be a C corporation from the absolute issuance of the stock.
So you can't just change it later.
No. It requires forward-looking strategic architectural planning on day one, not backward-looking compliance in year 6 when you're trying to sell.
That is wild. Okay, let's pivot back to our HVAC acquisition scenario, though.
Right.
Because our founder didn't start a software C Corp in that example. She bought an existing HVAC business using an SBA 7A loan. And let's say the business is booming, but her fleet of service vans is constantly breaking down, bleeding cash and maintenance.
Classic operational headache.
Yeah. She needs to buy 5 new commercial vans, which will cost roughly $350,000.
Okay, this scenario highlights the power of Section 179 and 100% bonus depreciation,
It's okay.
which, by the way, Dennis specifically notes, was restored in the 2025 tax legislation.
Right.
Under standard accounting rules, if you purchase a $350,000 fleet of vehicles, you cannot deduct that entire expense from your profits in year 1.
You have to spread it out.
Right, you're forced to depreciate the asset, deducting a small percentage of the cost over 5 to 7 years.
Which means you spend $350,000 in cash today, but only get to lower your taxable income by maybe $50,000 this year.
Exactly.
The cash is gone, but the tax bill remains high.
Exactly the problem. However, Section 179 allows you to elect to deduct the entire purchase price of qualifying equipment in the year it is placed into service. And the restored 100% bonus depreciation supercharges this by removing caps on the total amount.
So how does the math work for her?
Our HVAC founder buys the $350,000 fleet. She instantly deducts $350,000 from her net operating profit for that specific year.
Instantly.
Yes. So if the business made $500,000 in profit.
Her taxable income plummets to $150,000.
Exactly.
She fundamentally zeroes out her tax liability just by reinvesting capital back into the structural growth of her own company.
Yes.
The cash flow implications of that are just staggering.
And again, we return to the government's multiplier effect here.
Right, because they want her to buy the vans.
Yes. The IRS allows this massive deduction because they desperately want the founder to buy those 5 vans.
Because buying those vans keeps the automotive manufacturing plant running.
Which employs thousands of taxable workers. The government gladly sacrifices the founder's year 1 tax payment to guarantee the stability of the industrial supply chain.
It's all connected.
All of it.
And the sources also touch on advanced real estate incentives too, don't they?
They do. They detail historic rehabilitation credits and new markets tax credits.
How do those work?
The mechanics are very similar. If a developer acquires, say, a decaying warehouse in a designated low-income census tract
Okay.
and deploys capital to renovate it into commercial office space, the government subsidizes the risk.
Oh.
They issue direct tax credits equal to a percentage of the renovation costs.
So they pay you to fix up the neighborhood.
Exactly.
Yeah.
You are performing localized urban revitalization, and the federal government is heavily offsetting your capital expenditure directly through the tax code.
Let me throw one final, highly specific pushback your way regarding tax deductions, though.
All right, hit me.
Carlton Dennis talks about deducting the cost of high-level education and mentorship.
He does.
He says if you pay an expert for consulting or join a high-ticket mastermind group, it is fully deductible.
Right.
That sounds incredibly aggressive to me. I can just hear an IRS auditor laughing at me for trying to write off a $20,000 networking retreat in Cabo, you know?
Yeah, you have to be careful.
So what are the actual boundaries of deducting education?
The boundary is defined by the IRS criteria of ordinary and necessary.
Ordinary and necessary.
Yes. The deduction must directly relate to maintaining or improving skills required in your current trade.
Okay.
Ordinary means the expense is common and accepted within your specific industry. Necessary simply means it is helpful and appropriate for your business. It does not have to be strictly indispensable.
Okay, give me a clear delineation between what passes an audit and what fails, because people get this wrong all the time.
Okay, if you own a marketing agency and you pay $10,000 to attend a high-level mastermind entirely focused on integrating generative AI into marketing workflows,
That makes sense.
right, that is inherently ordinary and necessary for your survival in that industry. The cost is fully deductible.
Okay, and a failure.
If you own a commercial plumbing business and you pay $10,000 to attend a mastermind on cryptocurrency day trading,
Right.
that expense fails the test completely and will be immediately disallowed in an audit.
Because it has nothing to do with plumbing.
Exactly. The government is willing to subsidize your professional upskilling because a more competent founder scales a larger business, which eventually yields higher corporate taxes. But they won't subsidize a side hobby.
It totally reframes the entire concept of investing in operational knowledge.
It does.
It's not just an out-of-pocket expense. It is a heavily tax-advantaged capital deployment.
Well said.
But having laid out this dense architecture of QSBS, Section 179, SBA underwriting, and tiered county grants,
It's a lot.
I have to point out the obvious barrier here.
Okay.
If a listener is geographically or socially isolated, like if they are operating out of a rural town and they don't have a high-powered San Francisco CPA on retainer, how do they actually navigate all this complexity?
That structural isolation is exactly what our final source, the Global Entrepreneur Hub, is attempting to solve.
Right, the script for that decentralized digital community.
Yes, operating across YouTube, TikTok, and podcast platforms. It operates on the premise of absolute democratization of complex financial information.
What's their primary mechanism?
The primary mechanism of the hub is breaking down geographical gatekeeping.
Okay.
The script directly addresses founders, whether they are in a Tier 1 county in Texas, a rural village in Asia, or a hyper-competitive market in New York.
Right, it's borderless.
Exactly. The core thesis is that the initial discovery phase of capital acquisition no longer requires paying a consultant $500 an hour.
They advocate for a process they call web browser deep dives, right?
They do.
Yo,
The deep dive strategy is about learning the specific syntax of government capital.
the syntax.
Yes, the vocabulary.
Yeah.
The money exists in public portals, but it is categorized under very specific bureaucratic nomenclature.
Oh, I see.
If a founder just searches free money for my business, they find nothing but scams.
Right, all the spam ads.
Okay. But if a founder learns to search their specific state's name, followed by terms like workforce training wage reimbursement, or state small business credit initiative, or targeted EIDL advance,
Tell what happens.
they instantly bypass the gatekeepers and land directly on the state-run application portals.
Okay, using my catchphrase here. So what does this all mean?
Well,
Is the Global Entrepreneur Hub claiming that high-level tax strategy is as simple as dropping a comment on a TikTok video or running a Google search?
no.
Because everything we just discussed about DSCR underwriting for a $2 million SBA loan or forming a C Corp to trigger a QSBS exclusion,
Yeah.
that inherently requires intense professional execution. You cannot TikTok your way through an IRS audit.
You are absolutely correct, and the distinction there is crucial. Execution requires a licensed professional.
Right.
You must hire a CPA to execute the Section 1202 filing. You must use a professional underwriter for the SBA 7A.
Okay.
But the discovery of the strategy is entirely decentralized and free.
Discovery versus execution.
Exactly. You cannot ask your CPA to structure your entity for a QSBS exit if you don't even know what QSBS is in the first place.
Right. If you don't know to ask you, they might just put you in an LLC.
Exactly. The digital community provides the strategic vocabulary. You discover the strategy in the borderless digital hub, and you execute it locally with your professional team.
The government isn't obfuscating the capital. They just rely on highly specific language.
Yes.
And the digital community essentially acts as the translation layer between the bureaucracy and the founder.
They are essentially open sourcing the cheat codes to the global economy.
I love that.
A founder in Ohio figures out how to navigate the Jobs Ohio Training Grant portal,
Mm-hmm.
shares the exact application steps on the hub, and suddenly a founder in rural North Carolina realizes they can run the exact same play with the NC Edge program.
Which brings our whole deep dive full circle, really.
It does.
We started by examining the macro-level philosophy of the federal government in the 1930s,
Right.
using capital injections to prevent economic collapse, and later, engineer an anti-monopoly landscape.
Yes.
We tracked that capital as it flowed down into aggressive interstate bidding wars, where states heavily subsidized businesses to locate in distressed Tier 1 counties.
We examined the non-dilutive microgrants that fund the initial startup runway, like the NCIDA grants.
And the SBA debt vehicles that allow founders to completely bypass the startup phase entirely.
Just go straight to acquiring cash-flowing assets while retaining total equity control.
And finally, we mapped those advanced structural defenses, QSBS, Section 179, that allow founders to aggressively protect the wealth generated by those assets.
Right. The ultimate takeaway from all these sources is that success in 2026 is not solely defined by top-line revenue or product innovation.
No, it's not.
True financial velocity is achieved by treating the local, state, and federal government as a strategic partner.
Which is wild to say out loud.
It is, but it's about understanding the rulebook so intimately that you can leverage their massive balance sheet to fund your growth, while utilizing their tax code to defend your harvest.
The infrastructure is meticulously built, fully funded, and waiting to be deployed.
The capital has already been allocated in the budget. It's just sitting there.
It's just sitting there. The government has mathematically assumed that a specific percentage of aggressive, informed entrepreneurs will step forward, learn the mechanisms, and claim those billions to scale their enterprises.
Exactly.
Which leaves you, the listener, with a highly provocative reality to consider as we wrap up.
Think about this.
The capital is sitting in an account right now. If you don't build the strategic framework to claim it, whose dream is your unclaimed money currently funding?